Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest report from Ares Industrial Real Estate Income Trust, and it's filled with more twists and turns than your average warehouse aisle. You might think real estate is boring, but trust me, this has drama, numbers, and a retiring executive. Okay, let's start with the basics. This is a Form 8K report, which is like a quick update a company sends to the Securities and Exchange Commission, the SEC, whenever something important happens. It's not their full yearly report, it's more of an urgent news bulletin. In this case, it covers a few key changes and updates that investors should know about. First up, let's talk about some leadership changes. Scott Recknor, the company's head of asset management, decided to hang up his hat and retire. He told the company in April about his plans, and his last day will be in June. He's sticking around until then to help with the change so that everything keeps running smoothly. Now, let's talk about money, specifically net asset value, which is like the company's estimated worth. The transaction price for shares of Ares is equal to the net asset value per share as of March. To calculate the net asset value, the board of directors uses a bunch of methods that they update every so often. Basically, they try to figure out what each share is really worth. You can find the most recent numbers on their website and on a toll-free number. To make sure these numbers are correct, the company hired Altus Group as their independent valuation advisor. These guys help figure out the value of the real estate in the portfolio, review appraisals, and keep an eye on the loans they've made. They even help develop the methods used to determine the net asset value. It's like having a financial detective to make sure everything is on the up and up. Alright, let's get to the numbers. Here's a quick peek at their financial health. Their investments in industrial properties totaled about $8.93 billion as of March, which is slightly more than the $8.9 billion from February, so it went up slightly. Now the big one, the aggregate fund NAV, that's the total value of everything. As of March, it was about $4.38 billion. In February, it was $4.36 billion, so overall their net asset value went up a little. The total fund interest outstanding, which is the amount of shares out there, were at 543, so they issued slightly more shares, which does impact the share price. Now, let's look at the net asset value per share, or NAV per share. That's the money we really care about. As of March, each share was worth 12 tons at 86 cents. That's a tiny bit more than February when it was at 12 tons at 84 cents. That's not a big move. It's important to remember that this number is just an estimate. It's not a guarantee that you could sell your shares for that much, or that the company could sell all its properties for that amount today. It also doesn't factor in things like the costs of selling properties. Okay, let's talk about the crystal ball part of real estate, predicting the future. They use something called exit capitalization rates and discount rates to guess what their properties will be worth down the road. As of March, the exit capitalization rate was 5.7% and the discount rate was 7.4%. The average holding period for their properties is about 10 years. Basically, these rates are used to figure out how much money they expect to make when they eventually sell these properties. Now, if these rates change, it could have a big impact on the value of their real estate. If the exit capitalization rate went down by just a bit, say 0.25%, the value of their properties could go up by 3%. But if that same rate went up a little, the value could drop by almost 3%. Discount rates work in similar ways. Speaking of money, they authorized monthly gross distributions for each class of shares. The distributions amounted to $0.05 per share for March. Let's check out the real estate itself. As of March, they owned 255 industrial buildings. These totaled about 54.7 million square feet. In 30 markets across the US, they're renting these buildings out to 430 customers, and they're about 94.8% full. The average lease has about 3.8 years left on it. Their leverage ratio was around 45.6%. That's calculated from borrowings divided by the fair value of their real property. The weighted average interest rate they're paying on their loans is 4.75%. For the quarter that ended in March, they took in about $128.6 million from things like reinvestments and sales. They also spent $75.5 million to buy back shares that investors wanted to sell. Let's look at those industrial buildings again. Out of those buildings, 252 make up their operating portfolio. These have tenants and are up and running. 3 buildings are in their value add portfolio. These are properties they want to improve or rebuild. Also, they manage 1 building that is still in the pre-construction phase. During the past year, they signed leases for around 7.2 million square feet of space. Also, their rents are below market value, so they have lots of opportunity to continue raising rents. Most of their buildings are bulk distribution centers used for warehouses. Across the whole real estate portfolio, the average effective annual rent is about $7.51 per square foot. Here are some of their top markets. Atlanta is a big one with 21 buildings and leased space. Their Charlotte operations are 100% leased. Looking at their real estate portfolio, New Jersey is the top market, worth 9.9% of real estate value. Okay, who's renting all this space? As of March, only one customer accounted for more than 5% of their total space. Here's a look at some of the customers. Amazon is the biggest customer, making up 73%. The biggest chunk comes from transportation and logistics. That's it for the report, and the lawyers made sure to mention that predictions about the future are just that, predictions. Lots of things could change. Now, what's my take on all of this? Overall, Ares Industrial Real Estate Income Trust looks like a fairly steady player in the industrial real estate game. Their properties are mostly occupied and they're spread out across different markets and industries, which helps to lower risk. One notable strength is that rents are below market rate, so there's still plenty of upside. A potential weakness is their leverage ratio, because too much borrowing can cause issues if the market slows down. Also, the retiring head of asset management may impact things, but he will stick around to help. Overall, I think the company is on a solid path. They're in a good sector, their properties are well occupied, and they're making money. Thanks for watching Corporate Decoder. If you found this helpful, please subscribe, like and comment. Let me know which company you want me to decode next.